First, I will tell you what you need to know. Not how to find high probability setups, but how the market actually moves and how to predict its moves. So then I will tell you how to find and recognize strong movements so you don't miss anything, and we move from easy to not so easy. So today we discuss Forex pairs, but this works actually on any market, so if you want I will describe all nuances for any other market you want. So let's start. Psychology and other topics are important, but nothing is as much important as technical understanding of the market. So if you truly know where price is going to move, you will never doubt your position. Doubt actually comes from not knowing, and not knowing comes from skipping the technical foundation. So this is what we fix today. And everything in this market is connected, so no pair moves alone, no candle happens randomly. Before you look at any setup, you need to understand the relationship between instruments. So when you see this, you stop reacting to price and start reading it. In Forex market, US dollar is the key to everything. Every major pair is just the dollar on one side. And if you know what dollar is doing, you know what all majors are doing. So crosses are just not dollar pairs combined, so we will not touch them. And if you can read one instrument correctly, you can trade them all. So here you can see a good example. Dollar and euro moving in parallel, both sweeping for our fractal and moving significantly in the same direction. This is clean scenario, but it's not always like this. Often you will see one of them making the sweep and the other one not. And it's a moment when you need to trust dollar, always. So if you spend time analyzing only euro and trying to trade it in isolation and then switch and start trading together with dollar analysis first, it will immediately become easier. Everything will make more sense because dollar is a primary mover and euro often reacts to it. Here you can see the whole Forex market moving in one direction because of fair value gap fulfillment on the US dollar. So dollar did the thing, everything else followed. Most traders start with entries. This is their, of course, first mistake. Entry is the last thing you think about, not the first. So first you understand the direction. Then you understand where you are in the movement. Then you wait for confirmation. That's it. So entry becomes obvious. If your entry is not obvious, it means one of the earlier steps is missing. Localization is not about direction. You already have that from the higher time frame. So if your main time frame is daily, for example, localization is 4-hour time frame. The daily gives you the idea, and 4-hour shows you the place where that move will actually start. So this is where you stop guessing and start seeing. Localization brings you from I know where price is going to I know exactly where to look for the triggers. The same chart as before, but now we drop to the low time frame, so it's localization. On the 4-hour you have the sweep, that is your idea, and this is your direction. Now you go to 1 hour and here you see clean rejection and a clean sweep as well. So same story on one time frame lower, second confirmation is your localization. You're no longer just assuming the move, so you are seeing it build in real time on lower time frames. 4-hour told you where, and 1 hour is now showing you it's actually happening. So this is where you open the trade. Volume is one time frame lower than your localization. So if localization is 4-hour time frame, volume is 1 hour or 30 minutes, for example. And here is why it comes after localization. You already have the idea, you already have the place, and now you need confirmation that the move is real. So volume shows you the market model, a spike of volume at the exact moment where localization sets the move begins. So this spike is not random. That is the market telling you something is happening right here, and that is your signal. You have the idea, you have localization. Now one step lower, and this is where you actually enter. On the 15-minute time frame, you do not enter on the first rejection. You do not enter on the first anything. You wait. You need two confirmations that price is moving in your direction. At minimum, you need a fair value gap in your direction. That's baseline, so no FVG, no trade. Here you can see one of my confirmations, inverted fair value gap, and after that we're reaching the target in a very clean way. This is full chain. For example, if you're choosing those time frames, daily gives the idea, 4 hour gives the location, 1 hour confirms the sweep. So 15 shows the fair value gap, and this is your entry. Every step had a reason, nothing was guessed. About timing, everyone talks about sessions, London Open, New York Open, overlap, lunch, and so on. And yes, it's better to have your entry happen during active session hours, but I look for that too. But timing is, that sense, is not what matters most. What actually matters is the timing of your chain. So daily gives you the idea, 4 hour gives you the location, and lower time frame gives you a volume confirmation. So when all three align at the same moment, this is your timing, not the clock, not the session. So session timing is like a nice extra, but time frame chain timing is everything.